Hello, good day. In this video, I'm going to introduce the basic terminology and characteristics of options. At the end of this learning session, it is hoped that students will be able to differentiate call option and put option, understand how these investment vehicles is used in trading. In addition, students will learn how to calculate intrinsic value, payoff, profit and loss from options. Stay tuned and let's learn together. In section 1, I will introduce the basic concepts about options. For a start, let's understand options as derivatives. Options are contractual instruments. It is a financial contract between two parties to transact an asset at fixed price at a future date. Owners of options have no voting rights, no privileges of ownership, and no interest or dividend income. Options are derivative securities that derive their value from the price behavior of an underlying real or financial asset. Options are a form of contingent claims because their payoffs are contingent on the prices of other securities. What is an option? An option is a unique type of financial contract because it gives the holder or owner the rights, but not the obligation, to buy or sell a specified asset at a stated price on or before a given expiration date. Investors who buy options acquire nothing more than the right to subsequently buy or sell other related securities. There are two basic kinds of options, call options and put option. A call option gives the holder the right to buy an asset at a specified exercise or strike price on or before a specified maturity date. A put option gives the holder the right to sell an asset at a specified exercise or strike price on or before a specified maturity date. A put option can be viewed as the opposite of a call option. To help you to remember easily, just take note that call means buy and put means sell. A call option gives the right to buy. A put option gives the right to sell. There is a special vocabulary associated with options. Here are some important definitions. Strike price or exercise price is the stated price at which buyer of call options can buy a security, or buyer of put option can sell a security. Strike price is predetermined or fixed upfront when the option contract is originated. It is the fixed transaction price of the underlying asset in the option contract. It is the price at which the asset can be purchased or sold by the holder of the option contract in the future. The expiration date specifies the life of the option and the length of the contract between the holder and the writer of the option. An option usually has a limited life. The option is said to expire at the end of its life. The last day on which the option may be exercised is called the expiration date or maturity date. After this date, the option is worthless. Option premium is the market price of the option. It is the purchase price that the buyer pays to buy an option. The buyer of option contract pays a premium to acquire the right to buy or sell the underlying asset at the strike price. The premium is paid by the buyer to the seller or writer of the option. Premium is subject to continuous change in response to the economic forces of supply and demand. Premium is affected by the current value of the underlying assets, exercise price, values of related assets, expected volatility, expiration dates, and so on. Options are contractual instruments whereby two parties enter into a contract to give something of value to the other. Both parties are counterparties of each other. I hope you will read and go through the comparisons in detail. The option buyer is also known as holder or owner. The option seller is also known as maker or writer. The buyer pays a premium to the seller and receives a right to exercise an option. The buyer has the right to exercise the rights in the contract, and the seller has the obligation to fulfill the terms of the option contract. The buyer can walk away from a bad option, but the seller cannot. Options can be designed to provide a choice of when the contract can be exercised. What are the key differences between European and American option? A European option can be exercised only at the end of its life, that is, on the maturity date. An American option can be exercised at any time during its life. An American option can be exercised on or at any time before maturity. The asset that the option holder has the right to buy or sell is called the underlying asset. Underlying asset refers to the asset stated in the option contract and to be transacted. The option derives its value from the value of the underlying asset. Today, investors can trade puts and calls on a wide range of underlying assets. For example, common stock, stock indices, debt instruments, foreign currencies, commodities, and futures contracts. In terms of trading strategy, if we expect market price of the underlying asset to increase, we should buy call option. Buying call option is a simple and popular option strategy for bullish investors. If we expect market price of the underlying asset to decrease, we should buy put option. Buying put option is a simple and popular option strategy for bearish speculators. There are four types of option positions. Long means buy, short means sell. We shall learn further how to analyze profit and loss from these four positions. Option premium has two components, the intrinsic value and the time value. Intrinsic or fundamental value is based upon the current market price of the underlying assets. Time premium is the amount that the option premium exceeds the fundamental value. The longer the term to expiration, the higher the time premium. The closer to expiration date, the lower the time premium. When the option is in the money, the intrinsic value is positive. An option is described as in the money when its exercise would produce profit to its holder. Options are at the money when the asset price and the exercise price are equal. When the option is out of the money, the intrinsic value is zero. Its exercise would be unprofitable. How to calculate the intrinsic value of an option? A call option is in the money when the asset price rises above the exercise price. Therefore, the intrinsic value is equal to the asset price minus exercise price. The situation is reversed for put options. A put option is in the money when the asset price falls below the exercise price. Therefore, the intrinsic value is equal to the exercise price minus asset price. An out of the money option or an at the money option will have an intrinsic value of 0. This option will only have time value. Let's look into an example. In this example, the premium for the call and put options on ABC shares are listed. There are 3 expiry months and 3 exercise prices. Do you notice that the higher the exercise price, the lower the call premium? In contrast, the higher the exercise price, the higher the put premium. In addition, the longer the expiration date, the higher the option premium. On 1st April, ABC share was traded at 115 pence per share. At the same time, the call option with an exercise price of 115 pence and an expiry month of June is trading at 9 pence. The 9 pence is the time value, as the option is at the money at 115 pence, where the intrinsic value is 0. In section 2, we are going to learn how to calculate profits and loss from options. Let's try to calculate the profit or loss for a call and put option. An option contract has a strike price of $600. The call premium is $20 and the put premium is $20. Calculate the profit or loss for the call and put option if the market prices of the underlying asset range from $500 to $700. Draw a graph to show the relationship between the market price and the profit or loss of the options. The figure shows the profit or loss earned by a call buyer and a call seller. If the market price is below $600 at the time of expiration, the call buyer will lose money on the call purchase. However, the amount of the call buyer's loss can be no more than $20. Risk of the buyer is limited to the call premium. The call buyer is in a loss position unless the market price rises to $620, which is the strike price of $600 plus the call premium of $20. The call buyer's break-even point is reached when the market price rises to a level equal to the strike price plus the call premium paid. For market prices above $620, the call buyer's profit per share will rise dollar for dollar with the market price. The call buyer's profit potential is unlimited when the underlying stock price rises above the break-even price. The call buyers have unlimited profit potential with limited loss potential. The seller or writer of a call option incurs the obligation to sell the underlying asset at a predetermined strike price if requested by the buyer of the call option or the call holder. If the market price is below $620 at the time of expiration, the call seller will make money on the call sale. The amount of the call seller's profit can be no more than $20. The call seller is in a profit position until the stock price rises above 620, which is the strike price of 600 plus the call premium of $20. For market price above 620, the call seller's loss per share will rise dollar for dollar with the market price. The call seller has unlimited loss potential with limited profit potential. Option transactions are zero-sum game in which the call buyer's profit comes at the expense of the call seller. The profit of the writer has a payoff pattern that is the mirror image of the payoff pattern for the call buyer. This figure shows the profit or loss earned by a put buyer and a put seller. If the market price is above $580 at the time of expiration, the put buyer will lose money on the put purchase. However, the amount of the put buyer's loss can be no more than $20. Risk of the buyer is limited to the put premium. The put buyer is in a loss position unless the market price falls to $580. Which is the strike price of 600 minus the put premium of 20. The put buyer's break-even point is reached when the market price of the underlying asset falls to a level equal to the strike price minus the put premium paid. For market price below $580, the put buyer's profit per share will rise dollar for dollar as the underlying asset price falls. The put buyer's profit potential is limited only by the fact that the price of the underlying asset can fall no lower than zero. The put buyer has limited loss potential and profit potential that is limited only by the fact that the underlying asset price can fall to no less than zero. The seller or writer of a put option incurs the obligation to buy the underlying asset at a predetermined strike price if requested by the buyer of the put option or the put holder. If the market price is above $580 at the time of expiration, the put seller will make money on the put sale. The amount of the put seller's profit can be no more than $20. The put seller is in a profit position until the stock price falls below $580, which is the strike price of 600 minus the put premium of 20. For market price below $580, the put seller loss per share will rise dollar for dollar as the underlying market price declines. The put seller has limited profit potential and have loss potential that is limited only by the fact that the underlying asset prices can fall no lower than zero. Option transactions are zero-sum game in which the put buyer's profit comes at the expense of the put seller. The profit for the put writer has a payoff pattern that is the mirror image of the payoff pattern for the put buyer. Finally, we have come to the end of this video. I hope you have learned some knowledge from this video. If you like this video, please click like, share or subscribe to my YouTube channel. Thank you. See you and goodbye.